everyone, continuing from the previous video, we'll be taking a good look at some of the very key important terms in stock market, in investments, related to financial literacy. I am explaining the terms in very simple words and I'm explaining their meaning. So let's get started. We'll start with the terms which are related to investment methods. First one is called as SIP investing. So it's a systematic investment plan. You're investing in a fixed amount in mutual funds at regular intervals. Number two is called as lump sum investing, where you're investing a large amount in mutual funds all at one go. Next section we will be dealing today is called as different markets. First one is called as an equity market. Now the market where the company ownership or the equity is bought and sold. The stock market is also called as an equity market itself. Now, forex market, some market where different countries' currencies are traded, like USD, INR, Euro, Yen, etc. There's another market which is called as commodity market. A market where various commodities like gold, copper, silver, crude oil, etc. are traded. That is called as commodity market. Now, in the next section here, we'll be taking a good look at the key terms related to derivatives. What are exactly derivatives? And the key terms which are related to derivatives. In very simple terms, I'll explain you these terms. First comes derivatives. So whenever there is a financial contract whose price depends on the price of something else, that is called as derivatives. So the main type of derivatives are futures, options, and swaps. Now, first, what are futures? So contracts where two people agree to a transaction on a fixed future date at a price agreed upon today. That's futures. Second one is called as options. Contracts where the buyer gets an option to buy or sell something at a fixed price on a fixed date from the seller. That is called as options. Now there are two kinds of options. First one is called as a call option, where it gives the buyer the option to buy something, and second one is called as a put option, where it gives the buyer the option to sell something. Now then next term comes is called as swaps. Now, contracts where two people agree to exchange cash flows from different investments over a period, that is called as swaps. Now, let's dive into the next section where we'll be learning about the key terms and their meaning in very simple language associated with trading actions and market behavior. First is called as short selling. So selling shares first and then buying them back later at a lower price to make a profit, that is called as short selling. This is typically done in intraday trading or with derivatives. Number two is called as going long. Buying a stock hoping its prices will rise to make a profit, that is called as going long. Number three, which is called as going short, selling a stock hoping its price will fall to make a profit. Then there's a very important term which you might have heard often, which is called as volatility, which is how quickly a company's shares prices would move up and down. High volatility means fast price movements. Then next term is called as beta. Now it shows that how much more or less volatile a company's stock is compared to the overall stock market index. And a beta of 2 means the stock is twice as volatile as the index. Next comes is the very important term which is called as volume. So the number of shares of a company that were bought and sold in a day, that is called as the volume. Next come is lot size. So for some shares or derivatives, you can only buy or sell them in a fixed bundle called as lots. Now the quantity in one bundle is called as a lot size. Now we'll be dealing with and understanding the terms associated with order types. First one is called as the market orders. Placing an order to buy or sell shares at the current market price is called as a market order. Number two, limit orders. Placing an order to buy or sell shares only when the price reaches a specific level as you have set. Number three is stop loss order. That is an order placed to limit losses when you're buying or selling a particular set. Okay, now next we will be learning about the key terms related to price dynamics. Number one is called as the bid price, which is the highest price of an investor who's actually willing to pay to buy the company's share. So that's the highest price an investor is willing to pay. Number two, ask price. Ask price is the lowest price an investor is willing to accept to sell a company's shares. Number three is called as bid ask spread. So that's the difference between the bid price and the ask price. Number four, that comes as circuit limit. So the fixed limit by which a company's shares price can increase or decrease in a single day. This can range between 2% to 20%. Next comes face value. So the initial price of one share when the company started, that's called as the face value. Now, section number, which is related to all the corporate actions. Let's get a deep dive of the different kind of terms and making and simplifying them in the easiest way to learn them better. What are different kind of terms associated with corporate actions? First, corporate actions means decisions a company make for its shareholders. So there are five kind of types of corporate actions that it does. First is dividend, second is bonus shares, third is stock split, fourth is buyback, and fifth is right issue. First comes the dividend. So a portion of a company's profit distributed among its shareholders, that is called as dividends. Number two is called as bonus shares. When a company gives extra shares to the shareholders for free based on the shares they have already hold. Number three is called as stock split, where a company divides its shares into multiple shares. That is called as stock split. Next term is called as buyback, when a company buys its own shares from the stock market. And the last term related to this is called as right issue, which is a process for raising funds when a company gives its existing shareholders the right to buy new shares at a discounted price before offering them to public. So that's called as the right issue. There is also one term which is related to the fixed date, which is called as X date. So a fixed date, which is to be eligible for a corporate action benefit, you must own a company shares before its date. That's called as a fixed date, X date. And there's something called as retained earnings, the profit a company keeps after paying dividends. Now the next very important valuable term and terminology is related to analysis and valuation is number one is called as technical analysis. So when you're doing the guessing price movements by analyzing the share price charts, we're using the signals called as indicators. Next one is called as fundamental analysis. So you're doing the detailed analysis of companies' financial statements and business. Next term is called as intrinsic value. So the true value of a company is based on its business is called as its intrinsic value, and it's different from the share price. Then comes undervalued, when a company's share price is lower than its intrinsic value. Overvalued. What is overvalued? And you might have heard that when a company's share is higher than its intrinsic value. Then there's something called as value investing. So buying shares when their price is less than their intrinsic value, that is called as value investing. This is a very important and a very important term, which is called as Benjamin Graham, who's called as the father of value investing. And his strategy started with his book, which is called as Security Analysis in the 1934. Now, there's something called as valuation, and the process to find out a company is currently undervalued or overvalued, that's called as the valuation. Next, we'll talk about portfolio and regulations and the terms associated with it. The first term is called as portfolio. A collection of several investments is called as a portfolio. Number two is called as SEBI, that is the Securities and Exchange Board of India, the body that regulates the Indian stock market. The Indian stock market. So yeah, we have the Securities and Exchange Board of India. Next is called as SCORES, which is the SEBI complaints redress system, where it's a kind of a complaint portal in India for any fraud in the stock market, and its website is scores.gov.in. Now there's something called as insider trading, which is a very important term again, where it is a crime. you must know that insider trading is a criminal activity. So making a profit in the share market using information about a company that is only known to the people inside the company, that is called as insider trading. Now, next key terms will be related to company financials. Let's get started. The first one is called as financial statements, where it's a financial report that show a company's financial performance and strength. This would include income statement, balance sheet, and cash flow statement. So let's get started and see more in detail. First one is called as income statement, which is going to show a company's sales, expenses, and the profit or loss over a fixed time. Next term is called as revenue, whatever the total sales by a company, a fixed time is happening. Net income is the total profit or loss made by the company in a fixed time. And the most important term is called as EPS, which is called as the earnings per share. It shows the profit or loss a company made per share in a fixed time. If you are an economic student or not an economic student, everywhere we like in English also, we might have heard of the terms like assets and liabilities. So what are assets? So things a company owns that can be turned into money, like investments, land, buildings, machines, etc., are all in assets. And liabilities are different types of loans and obligations the company has to pay back in the future. There is also one important term which is called as shareholders' equity. So the money shareholders would receive after all the company liabilities are paid, that is called as shareholders equity, and it's also called as the net worth or the book value. Next is called as balance sheet. It shows the company's assets, liabilities, shareholders equity. Then comes cash flow statement, that shows the total cash that come into the company and where it was used. It is divided into three parts: CFO, CFI, and CFF. First one is called as cash flow from operating activities. That's the cash generated only from the company's main business, which we called as CFO. Second term comes is CFI, which is the cash flow from investing activities. It shows the cash generated or used for companies' investing activities. Third term, extremely important, CFF, which is called as the cash flow from financing activities, which shows cash generated or used for the company's financing activities. Other terms we're going to continue in the next class. Stay tuned. Have a good day.